Hello everyone, I am Professor Ashmita Basu and today I am going to discuss about the capital market. Now the capital market is the place from where the long-term capital is raised by the industry for the purpose of trade and commerce, and this particular process is done by issuing various types of securities. So the companies issue different types of securities, like we know equity shares, bonds, debentures, etc., in order to raise the capital from the capital market. Now, according to S.C. Kutchell, capital market consists of a series of channels through which the savings of the community are made available for industrial and commercial enterprises and public authorities. Now, what does that mean? It means that capital market provides a platform to these companies, to these industries to raise the capital. And where this capital is coming? It is coming from the savings of the community. So you or I, when we are saving the money for some kind of return in the future. So we don't want to keep the money idle, right? So what we do, we invest in some sort of instrument. When we invest in some sort of instrument, this investment is actually then borrowed by the industries. So it is basically giving a platform to both the parties. One is the borrower, the other is the lender. So the community people that who are saving, the households, they are becoming the lenders, whereas the companies are becoming the borrowers. And this way the funds are channelized from one end to the other end. Now, when we talk about the nature of capital market, it is very important because it forms a vital part of the financial market. So, financial market is the place where we know that dealings or tradings take place for different financial instruments. Now, financial market can be classified into two types, that is the money market and the capital market. Now, the money market is the market for the short-term securities, whereas the capital market is the market for the long-term securities. So, by short-term we mean the securities having maturity less than 1 year's time, and in capital market the securities are those which have maturity more than 1 year's time. Now, this capital market has got two segments, the primary market and the secondary market. Now, this primary market is also known as the new issues market. Now, why it is known as new issues market? Because whenever a company introduces its securities for the very first time, they are issued in this primary market or the new issues market. And that is why it is called the primary market. Now, the shares and securities are issued for the very first time through the initial public offerings or the IPOs. Once they are traded in the primary market as IPOs, then they are listed in the secondary market, which is nothing but the different stock exchanges. Okay. Now, the capital market has got two forms, which is the organized and the unorganized. The organized sector is highly regulated and it is controlled by authorities like SEBI, Securities and Exchange Board of India, RBI, the Reserve Bank of India, whereas the unorganized segment has got the local players. Now, what we see in the next point, that is the term securities are longer in nature, that is long-term securities, and these securities meet the long-term financial requirements. Okay, so this particular case we see that it helps in the capital formation and liquidity creation. So it is actually regulated market and it generates capital, it generates liquidity in the capital or the economy as a whole. It performs various trade functions, as we know. So our commerce and industry is looking up to this capital market for running their businesses. Now, what are the general features of the capital market instruments? Now, as I have already mentioned, the capital market instruments are long term in nature. So, long term in nature means their maturity is more than 1 year's time. So, any security that you see, whether it is equity share, whether it is bonds or debentures, all these are long term in nature because they have maturity in more than 1 year's time. Now again, when we are talking about long-term securities, associated with them is the risk. So these securities are very risky in nature because when we are talking about the long term, then the default risk associated with these securities is also very high. Now these securities are moderately liquid. Why not highly liquid? Because in case of money market, where the instruments have short-term maturity that is less than 1 year's time, they can be readily converted into cash. That is why all money market instruments are highly liquid, but in case of capital market, they are moderately liquid. The amount that is associated with the capital market, that is also low, and we have more investors in this type of capital market because they are long-term players and people try to diversify their risk by investing in more than one type of capital market instruments. Now, what we see over here is the structure of the capital market. Now, in general, when we talk about the structure of the capital market, we see that capital market can be divided into the primary market and the secondary market. As I have mentioned earlier, the primary market is for the initial public offerings, IPOs, that is the new issues market, and the secondary market is nothing but our stock exchanges. Okay, so those who are trading in the primary market, that means those securities which are being traded in the primary market, only those get listed in the secondary market. That too, not all of them. So it can be said that in secondary market, the number of securities that we find can never exceed those that are there in the primary market. The secondary market can be again further divided into two segments, that is the spot market and the derivatives market. Now, whenever you go to the website of a stock exchange, now we have in India the two biggest stock exchanges, that is the National Stock Exchange and the Bombay Stock Exchange. Now, if you go to this website of these two stock exchanges, you will see that they are dedicated into two different segments, that is the spot market and the other is the derivatives market. Now, what is the spot market? The spot market is basically where the instruments are being traded on a daily basis. Okay, and in case of the derivatives market, this we can refer to as a futures market. Okay, so derivative contracts have been developed at a later point of time in order to hedge the risk or diversify the risk. So this type of improvisations have been taking place because people, or rather investors, are risk averse. So they don't want to take high amount of risk, but they want high amount of gain. So how to maximize the gains or the returns and minimize the risk? That is the primary question. So in order to answer that question, new type of instruments are being introduced, and these instruments are going to help the investors to diversify their risk. So in case of derivative market, we come up across different contracts, like we have forward contracts, we have futures contracts, we have options contract, we have swaps contract, and many more. Now, what is the importance of the capital market? Particularly, capital market helps in the industrial development. So the industries are, I told you, looking forward to this capital market for starting their business, for running their business. So basically these industries have the financial development and growth with the help of the capital market. Now, increase in investment. As more and more new type of instruments are being introduced in the capital market, the investment avenues are increasing and investors are getting more interest in investing in capital market, and these instruments are satisfying their needs. That means it is giving different kind of features which are very important for the investors to invest in. So all investors will not have the same type of mentality or same type of investing capacity. So different instruments have been introduced and there are being many more to come, which are for the benefit of the investors. More liquidity in securities, because capital market is again dependent on the money market because they are being encashed, and capital is being formed for the industries, for the public authorities. So capital formation is a very important part of the capital market, and it also draws foreign investments. We have heard about FDIs, FIIs, that is foreign direct investments, foreign institutional investments. All these are highly interested in investing in the capital markets. So that is in a nutshell about the capital market. And with this idea of capital market, we can further deal with the different instruments in the capital market and try and understand the different segments of the capital market individually: the primary market, its instruments; the secondary market, its instruments; and the subdivisions of secondary markets into the spot and the derivatives. So with this small introduction, we come to an end of today's discussion and hope in future we will be having more discussions on each segment of the capital market. Thank you.